Good afternoon, Upper Keys Rotary Club. Cale Smith here. This is a narrated version of my slides from lunch today. Real quick, 3 financial topics that have been in the news lately that we wanted to sort of quickly address today. Jill had originally asked if I could prepare something on the state of the stock market given this recent correction, but as I thought about it, that part of the presentation we could probably do in pretty general terms in about 60 seconds or less. So here we go with that piece. Here is a snapshot of U.S. stock market valuations lately. This is a 5-year view, and we are over here on the right by that purple arrow, which is essentially pointing out that market valuations in general, and by valuation I mean the valuation multiple you are paying to buy U.S. stocks in general. It was until about 2 weeks ago as high as it has been in the past 5 years. So the point of this slide is just to sort of underscore that valuations recently have been elevated. And though these corrections always seem like the end of the world, especially if you watch a lot of CNBC, the reality is that the past few weeks were the 22nd market decline of greater than 5% since the old housing bubble induced lows back in March of 2009. So while the catalyst or the cause of each of these sell-offs is different each time, and this time it was really a very strong jobs report back on February 2nd that caused a brief, unexpected spike in bond yields. The reality is this sort of thing is not really so rare after all. So at the risk of treating this all a bit simplistically, I would just say that history would suggest that based on just those past 2 slides, the past few weeks, sell-off in the stock market has been overdue. It should be healthy for the market in the medium term, and though we haven't seen one lately, declines like this are not that uncommon either. So for today then, I thought it might be better to talk about something that is actually pretty uncommon, and that is the recently passed Tax Cuts and Jobs Act, or TCJA. We haven't seen major tax reform in about 15 years, and while it seemed like there were a lot of headlines about the politics of the tax cuts, there was not so much coverage after the fact on what it actually meant for taxpayers like us. And by the way, I'm not a CPA. I am an investment guy trying to stay ahead of the questions I expect we will be getting here over the next few months. So here is my attempt to summarize some of those highlights from the TCJA. First, from the corporate side, as you can see here, which is really where the most substantive reforms happened, and most notably that consolidation down of the corporate tax rate from, call it 35% on average, to 21%, and the fact that these changes here are permanent. When it comes to us, individual taxpayers, I think it's safe to say that new legislation is more of a series of cuts and tweaks, which probably introduces more tax planning complexity for a lot of folks, and also, unlike the corporate changes, I should point out, the changes for taxpayers are subject to a sunset provision after the year 2025, so they are not permanent. That said, the new tax laws do have a lot to like for individual households, almost all of whom will see a reduction of taxes in the coming years, though not after that 2025 sunset. And I'll show you this more in a second in the table, but big picture, while 7 of the tax brackets remain, most are decreased by a few percentage points. The new top rate is now 37%. The AMT, alternative minimum tax, remains, but its exemption is widened. Most common deductions remain, though they are more limited, and an expanded standard deduction means fewer people will likely claim itemized deductions at all in the future. So a lot to the new law, obviously. I just kind of cherry-picked 6 highlights here that I think were probably most relevant for the folks in the Rotary crowd at lunch today. Ultimately, the new tax rules are really complex enough that it will likely take months or maybe even years for all of the new tax strategies to emerge. So what I'm presenting here is really just the facts from the law itself, and I will leave it to you and your CPA to strategize on what is best for you personally and sort of how to navigate this as best you see fit. Okay, on the tax brackets. The good news, again, is that for most married couples, relative to today's tax brackets, the new tax brackets will produce at least a small reduction in the marginal tax bracket for virtually all taxpayers. And while the 10% and 35% brackets remain as is, the other 5 tax brackets all received about a 1 to 4% reduction in rates. There is one exception to this, though, and that's what's circled in red there. If you and your spouse made just more than $400,000 in income, but just under $425,000 income, then though you used to be at the 33% tax bracket, you'll now be at the 35% bracket under the TCJA. So, surprise. Also, as per that footnote, tax rates on capital gains and qualified dividends will remain the same. So this is a quick snapshot of what it looks like for married folks. Also, obviously, have a table for individuals as well. I just couldn't quite squeeze both in one slide. Moving on, another big outcome of the reform, they're merging exemptions into the standard deduction. So bottom line, under the new rules, the standard deduction will be $12,000 for individuals and $24,000 for married couples, as compared to just $6,350 for individuals and $12,700 for married couples under the 2017 law. The net of the slide is essentially that expanded standard deductions mean fewer of us are likely going to claim itemized deductions in the future. Kind of a lot going on in this table. I'd sort of highlight 2 big aspects of this, or the most notable 2 lines in here. The mortgage interest deduction is now capped at $750K. That's the second row down there. So, I don't think it's necessarily going to impact demand at all, but it might just be something for the realtors and the bankers in the room to be aware of. And then down a couple more lines on that charitable contribution line, for all of you folks running nonprofits, the net of it is that big donors can now donate more. The contribution caps have gone up there, so not a whole lot of changes on the small donor level, but on the upper end of that donor level, they can donate more. There's less restraint on them in that sense. If you're more of a visual person, here's a couple of screenshots on where on the actual Schedule A these sorts of issues will show up. Just going to kind of cruise through here, but kind of reiterating some of those earlier points on both parts of that Schedule A. All right, AMT. If you're first of all, if you're asking yourself what is the AMT, just consider yourself lucky not to know and move on. The bottom line with AMT though is that the end results of the changes in the new tax law is that we have an increased threshold for the AMT exemption phase out, along with a higher AMT exemption amount itself. So while the AMT commonly impacted those with between $150K a year in income and $600,000 income, the good news in the future is that AMT exposure will be much smaller, and frankly it'll be hard to be impacted at all, especially given more limited deductions. On qualified business income, the short version of this slide here is that there is a new rule that will allow pass-through business entities, and by that I mean partnerships, sole proprietorships, LLCs, and or S-corps to benefit from a lower tax rate. So I think this is fairly relevant to a lot of the business owners in the club. In practice, pass-through businesses will be taxed on only 80% of their pass-through income. And though these new rules have a number of restrictions in place, one of the probable consequences of this aspect of the new rule is that for some small business owners, it may actually make more sense for you to get paid as a contractor rather than as an employee. So, there's a lot to unpack in this little provision in particular. So, absolutely talk to your CPA for sure before getting too excited. But I do think that could ostensibly, impact a lot of people in the club. This last slide is probably most relevant to Tony and Pete, the folks at ICS, as well as really any parents with kids at, say, St. Justin's or Ocean Studies Charter School, any private schools in the Upper Keys here. And the short version is that 529 plans can now be tapped to pay for a private school too. So, to the extent that IRMA expenses have made private school less affordable for folks, perhaps this little provision could be of help to those school administrators here and some parents of those students too. And finally, kind of a snapshot of a number of other changes, just sort of cherry picked out of the code. I would highlight that second one down. As good as this tax reform bill is probably going to be for CPAs, it's arguably going to be a negative for estate planning lawyers. Specifically, the Act doubled the estate tax exemption amount to $11.2 million for individuals and $22.4 million for couples, which is going to essentially make estate tax planning really irrelevant in this year and beyond, sort of for everybody but the wealthiest of your high net worth folks. A couple other things that might personally apply to folks in the club. First of all, anyone with kids, a much wider range of families is now going to benefit from a sort of a greatly expanded child tax credit, and it has drastically higher income phase outs. Another one in there for realtors on the 1031 exchanges. Exchanges now are limited to just real estate. You used to be able to have a couple other asset classes in there, but you can't. It's just real estate now. And also, I sort of skipped over one. This is more for Joe and any of the property casualty insurance agents. Personal casualty losses will now only be deductible if they were incurred in a federal disaster area. So a couple other things that I thought were interesting for everybody. And finally, again, a couple of screenshots of things impacting the 1040. Not a ton on that first page there, but you start to see the real impact of that on the sort of the top half of the second page. And that may or may not be interesting, but there you go. All right, lastly, going to talk real sort of briefly here about Bitcoin. I will confess up front, it's hard to sound intelligent, I guess, when talking about Bitcoin, but here we go. Let's just start with the definition. Bitcoin is a digital cryptocurrency started back in 2009 by an anonymous person or anonymous group, we really don't know, called Satoshi Nakamoto. And if every phrase in that sentence doesn't give you a little pause or hesitation, then you're not alone. Let's just sort of break that up. What do we mean by digital cryptocurrency? The short version is that rather than the value of this currency being controlled by a single institution, like the Federal Reserve here in the U.S. controls the U.S. dollar, the value of a cryptocurrency like Bitcoin is essentially controlled by math. It's controlled by algorithms. Bitcoin miners, which you may have heard of, are essentially servers or clusters of servers who are using a lot of processing power to solve very complicated algorithmic equations, at the end of which they then produce another Bitcoin, and the supply of this currency is effectively controlled that way. I think I'll probably leave that at that for now. Let's look at the second, or I guess the middle part of the sentence. The fact that Bitcoin was started in 2009, I think is relevant to sort of understanding it. It was started sort of in the aftermath of the Great Recession, where a lot of people were disillusioned with the sort of the strength and the credibility of, call it, the global financial system. So it was arguably started as a direct response to the Great Recession that really impacted a lot of people. And the fact that it was started by an anonymous person or group called Satoshi Nakamoto, well, make of that what you will. I think the fact that it was anonymous is probably relevant in terms of sort of the origin of Bitcoin. Early on, my point being that it was used for illicit transactions, drugs, what have you, that sort of thing. It seems to have taken on a little bit more of a veneer of respectability, I guess. But I think I would trust your instinct to be skeptical about who is actually behind this, because the reality is we really don't know. It's probably relevant lately in South Florida anyways. We recently had, this is up in South Miami, we recently had the first Bitcoin-only real estate transaction in South Florida. And by that I mean the seller wanted to pay in Bitcoin, the buyer was okay accepting it in Bitcoin, and voila, there you go. So another screenshot on the left. I honestly don't know or don't think this is going to become much of a trend, but to the extent it's material for any realtors in the club that this sort of thing is going on in Miami, well, I guess it pays a little bit to know a little bit about Bitcoin, and I'll probably leave it there too. Probably a whole longer discussion related to real estate and hedging and sort of locking in a price. I guess the bottom line here is I would encourage you to, at this stage, be very wary, if you're not already, among the problems associated with Bitcoin or really any other cryptocurrency. They are not liquid. They're not freely tradable. So price discovery can really be an issue. Hacking, as you've probably heard, is a real problem, as is, frankly, the fact that it's used by shady parties or has been used by shady parties and certain governments around the world. North Korea, for instance, is still, I believe, one of the largest Bitcoin miners. So, keep that in the back of your head. Lastly, it's obviously hard to predict where all this is going to go. There's a lot of hype around it. I think, to put my own skepticism around it, it's really for one reason, which is that, the whole point of a cryptocurrency is that the supply of it is controlled, right? And it's not controlled by a central party like the Fed. It's controlled by sort of a decentralized group of servers, essentially. So supply is part of the attraction to it, I guess. Yet, ironically, there is no limit to the number of cryptocurrencies that can be created. So that seems to be a sort of a core fundamental conflict related to Bitcoin. And frankly, at this point, it's not clear at all how that is resolved. So if it's not Bitcoin that becomes popular, there are dozens and dozens at this point of other cryptocurrencies that are available. So it's just very wary of any and all of this, I suppose, is probably the bottom line, and then some. Okay, that was it. Hopefully this is a little bit more useful than sort of staring at a blank screen over lunch. But if there's any questions, by all means, please give a shout. Okay, thanks.